Welcome to ring fencing of assessed losses. This section was requested by a couple of students, and I decided that I was actually going to write a case study to actually explain to you how it works. I'd like you to get your psycholegislation handbooks and pause the video now, because I think you need your psycholegislation handbooks, and I'm going to show you how to tag it so that you could answer a Section 20A discussion question on ring fencing of assessed losses. So let's start by looking at this question. It says Herman Revere is a successful lawyer that regularly earns in excess of 5 million a year from his legal practice, who bought a game farm in Mpumalanga. Herman uses the game farm as a holiday home and weekend retreats, and in the current tax year, he and his family spend 45 days at the game farm. The game farm is also let out to various clients of Herman. He charges them 70% of the normal price they would pay for the game farm with similar facilities. During the year, the game farm is let by his clients for 80 days. No third parties, just his family who pay nothing and his clients who pay 70% of the normal price. There are 3 full-time employees at the game farm, being a cook, a cleaner, and a manager. Herman presented you with the accounts for the game farm. There were 80,000 in sales, 400,000 expenses. So there's actually a loss of 320,000 Rand. The 400 expenses, there's the 80,000 in sales, there's a loss of 320. He has heard that there's a section that may affect the owners of game farms. Now, if you're asked to discuss Section 20A, you need to have a look at all of the facts and know how to apply it. Okay. The trigger for me is there's a loss from a trade and he earns more than 1.75 million Rand a year. And I'm going to just explain the concepts to you. So if you open up the Psycholegislation Handbook, here's Section 20A, ring fencing of assessed losses. There are a whole lot of requirements. So I would do each of these in a different highlighted color so that you need to prove it. So the first thing that you need to do is prove that he's carrying on a trade. Okay, any trade. I'd highlight that in the first color. Is he carrying on a trade? Yes, he's running a game farm. So that would probably be the first mark in the question. The second requirement I'd highlight in a different color is carried on by a natural person. Section 20A, ring fencing of assessed losses, only applies to natural persons. So is Herman a natural person? Yes, he is. Okay. How does the section work? The next thing I'd highlight, okay, it says any assessed loss incurred during that year in carrying on of a trade may not be set off against any income of that person derived during that year, otherwise from carrying on that trade, notwithstanding Section 21B. So what is this basically saying? If I make losses on the game farm, I can only set them off against future gains on a game farm. Can only be set off against that trade itself. That's if the subsection applies. Because it says subject to subsection 3 over there. So guys, what are the further requirements that you need to know? Okay, so the next thing that it looks at is maximum marginal rate of tax. So then that's the next thing I would highlight and I would discuss in my solution. This only applies to people that get taxed at the maximum marginal rate of tax. Let's unpack this. What it means is you need to be earning 1.817001 or higher, okay, to be in the top tax bracket. This is a tax table, okay, and you need to be earning more than 1.817 million rands worth of income. Is Herman earning more than 1.817 million rands worth of income? Yes, he earns in excess of 5 million rand a year. So what have we done so far? He earns that maximum marginal rate. What's happening as well is he's made a loss, which may be subject to ring fencing. Is he carrying on a trade? Yes, tick. And is it a human being that owns all of this? Yes, tick. let's move on and let's actually have a look at the next requirement itself. So the next requirement says, as far as this is concerned, that the person has, during a 5-year period, okay, made a loss in at least 3 years. Okay, so highlight that. Or is carrying on a suspect trade. Okay, is carrying on a suspect trade. So any one of these items could be there, and you will see that farming is included. It says, unless you do this on a full-time basis, which is not farming on a full-time basis. So what will happen as far as this question is concerned is he hasn't made losses in 3 out of the last 5 years because this just bought the game farm this year. But is he carrying on a suspect trade? Yes, he's carrying on a suspect trade. So again, you'll go and put this into the solution and say, yes, he's carrying on a suspect trade. He's farming, okay? But he's not doing it on a full-time basis. Therefore, it's a suspect trade. The next thing I want you to highlight is the following. I want you to highlight a reasonable prospect of deriving taxable income. So the next requirement of a section is that you need to have a reasonable prospect of deriving taxable income. Let's unpack what's actually inside this question itself. So he doesn't charge himself for coming out to the game farm. He only charges out his clients at 70%, okay, of normal prices. So chances of reasonable prospect of making a taxable profit, not great. It's only let out for 80 days in a year out of 365. Chance of making a profit, not great. Okay, so is there a reasonable chance of making a profit? If you've only got 80,000 in sales and 400,000 worth of expenses, chances are you're not going to have a reasonable chance of deriving a profit. So I would highlight that over there. If you want, you can have a look at a couple of the things. It says having special regard to proportion of gross income in relation to amounts of deductions. 80,000 as to 320, not a good proportion. Okay. The amount of advertising, promoting, or selling, he only gives it out to his clients. He doesn't advertise out to the rest of the public. Okay. Is there a commercial manner taking into account the number of full-time employees? Guys, he's got a cook. Okay. Who are the 3 people inside there? There's a cook, a cleaner, and a manager. Does that sound like you're running a proper farm? Doesn't look like that at all. Okay. So, is the trade carried on in a commercial manner? No, it's not being carried on in a commercial manner. Okay. Obviously, you'd need business plans. Okay. And also the extent to which the asset is attributable or the trade is used. So it's used for 80 days out of 365. Not a great thing. Okay. So that is basically what's going to happen here. And what are we going to say? There's no reasonable chance of deriving a taxable profit. Therefore, the loss is ring fence. Can he claim the 320,000 assessed loss? No. Now, there's one final requirement which is not required for this question. It doesn't matter that you've got a reasonable chance prospect of deriving a profit. If you make losses in at least 6 years, okay, over a 10-year period, it doesn't matter that you've got a reasonable chance of making a profit. Okay, 6 years losses out of 10 means that this is ring fence. Section 20A will still apply. So guys, this is the way that I'd like you to do it. Go highlight those sections inside your books. And if you get a discussion question on Section 20A, use them. Now, the trigger in an exam, because you normally miss it in an exam. The moment you see someone earns more than 1.817 million a year, not including the suspect trade, and makes a loss on an outside business, you need to see whether Section 20A is going to be applied.